Okay, Chapter 7, Flexible Budgets, Direct Cost Variances, and Management Control, and this is Part 2. So we've talked about static budgets and static budget variances, and now we're going to look at a little bit more about standard costs, and we'll compute price and efficiency variances, which is really the major thrust of this. Then talk about how managers use variances and describe benchmarking. So just to go over this real quickly, that a variance is the difference between the actual results and expected performance. Okay, and the expected performance is also called budgeted performance. Management by exception is where we focus on the areas that need work. Static budget is another name for a master budget, and it's based on the planned output levels. That's what the static budget means. And the static budget variance is the difference between actual and budget. Okay, that's what it is. Now, favorable variance increases operating income, and an unfavorable variance decreases operating income. So for revenue items, unfavorable means actual is less than budget. For cost items, unfavorable means actual costs are larger than budgeted costs. And variances start out, we calculate them at multiple levels, and those levels are identified with level numbers. And the broadest variance is a level 0 and is a very macro view showing the difference between actual and static budget operating income. So further analysis breaks down the level 0 into progressively smaller and smaller components, attempting to answer more detailed questions. Now, the sales volume variance is the difference between flexible budget and the corresponding static, whereas flexible budget variance is the difference between actual and the corresponding flexible budget amount. So let's take a closer look. If a level 3 variances provide details of our level 2 flexible budget variances. So if a company has, for example, an unfavorable material cost variance, we can find out if it was due to the company using greater quantities of inputs versus the budgeted quantities, or because we paid higher prices per unit of input. Okay, so there's a price and an efficiency component. If, for example, we've got a company that has an unfavorable material cost variance, okay, that would be a price variance. We can find that out that it was due to a company using greater quantities of inputs versus the budgeted quantities, or having to pay higher prices. So on this slide here we see these three variances. The formulas to calculate the price and efficiency variances are shown here. And these formulas work equally well for direct material and direct labor, but will not work for overhead. So the formula for price variance is actual price minus budgeted price times the actual quantity of input. Okay, and the formula for efficiency variance is actual quantity of input used minus the budgeted quantity of input allowed for actual output. Okay, that's the thing. So budgeted quantity for the actual output times the budgeted price of the input. Okay, the actual quantity of input used can be yards or pounds of material or direct labor hours or machine hours. And the budgeted quantity of input allowed for actual output, that means that we'll take the quantity expected to be used per output. So for example, 4 pounds of steel per item times the actual quantity or the actual number of items. As an example, if we made 10 units and each required 4.4 pounds of plastic, we would expect to have used 44 pounds of plastic. If we actually use 48 pounds of plastic, okay, that element of the formula would be 48 minus 44. If we made 10 units and each required 5 hours of direct labor, we would expect to have used 50 hours of direct labor. If we actually use 5, that element of the formula would be 55 minus 50. Okay, actual minus the budget. in level 3 analysis looks at the flexible budget variance, the difference between flexible budget and actual results, and explains it in more detail. So we're taking that one column and opening it up some more. We know, for example, from level 2 analysis that this web company, that's the company in the textbook, had an unfavorable direct material variance of 21.6. Just looking for it here. Here's our right here. 21.6 is unfavorable direct material variance. That means we spent 21.6 more for the materials than we should have. This level 3 analysis tells us how much of that was based on the price we paid. Okay, that's the 44.4, more or less. More or less for the material than we expected to, and how much the amount was based on usage or efficiency. And you can see that the situation is even worse than it appears. We spent $66,000 more than we expected to on usage here, okay, that's unfavorable, which was offset by $44,400 favorable purchase price variance. And these variances provide infinitely more information to management to really help with operations in the future. Okay? Here's an example of direct manufacturing label beneath it. We can see that they took, like we thought they should take, 9,000, let's see, 9,000 hours, should take $20 an hour, should have taken, we don't have the hours on here, but you can tell that the efficiency wasn't there. Well, 8,000. They actually took 9,000 hours, and the budgeted rate would have been 8,000 hours. So they used about 1,000 hours more than budgeted. So that would be 1,000 at $20 an hour. That's our efficiency variance of 20,000. And for price variance, we expected to pay $20 per hour, but we paid 22, so the price was higher. So not only was the labor more expensive, but also the usage was greater. So maybe they had trouble with the machine or something like that. You really don't know till you look into it. And here's a nice summary of the variances. This is the static budget variance, okay, which would be the total of flexible budget plus sales volume variances. That would be the total static budget variance. Then if we took the flexible budget, comes apart some more, and we can take it apart into price and direct materials variance, labor variances, and then variable and fixed overhead variances. Okay? Direct material variance can be taken apart some more into price and efficiency variance. And labor can also go into labor, price, and efficiency. Okay? So level 3 targets the level 2 line item variances and breaks it down into more detail. So this is a good summary of this. Variance is actually very complex, but you need a good way to remember it. So budgeted input prices and budgeted input quantities can be obtained from a number of sources, including actual input data from past periods, data from other companies that have similar processes and standards, or developed by the firm itself. And a standard is a carefully determined price, cost, or quantity that is used as a benchmark for judging performance. And of course, each of these has its own advantages and disadvantages. Sometimes the term budget and standard are confused. Budget is the broader term, but when standards are used to obtain budgeted input quantities and prices, the terms are used interchangeably. Okay. Variances are journalized into individual variance accounts, and favorable variances are credits because they increase operating income, and unfavorable variances are debits because they decrease operating income. Think of it as similar to an expense. And if it's immaterial, variances are closed into cost of goods sold at the end of the period. All right, they would just cause more confusion. Now in Chapter 4, we looked at journal entries when normal costing was used. When standard costing is used, variances are recorded a little bit differently. And as an example, see the purchase material, since the purchase material will be recorded at standard, the price variance will be recorded at the purchase rather than when used. Okay, so for material variances, those are based on when the material was purchased, okay, whereas the usage variance or quantity variance will be based on how much is used. And we'll go through this in the problems. Management's use. Managers and management accountants use variances to evaluate performance after decisions are implemented. Also to trigger organizational learning and to make continuous improvements. Variances serve as an early warning system to alert managers to existing problems or prospective opportunities. So management accountants are more valuable to managers when they use benchmarking data to provide insight into why costs or revenues differ across companies or within plants of the same company, as distinguished from simply just reporting the magnitude of the differences. Okay, you've got to get down into the weeds a little bit and figure out what's going on. In the next slide, we've got some measures of the efficiency of airlines, and airlines are evaluated based on the cost per available seat mile. Okay, so here is United Airlines, and they're comparing United to Alaska Air, American, Delta, JetBlue, Southwest, and US Air. There are only about, let's say, 7 to 9 airlines, okay? Alaska Airlines is really small. It's really small. I think American is gone now, isn't it? Or they consolidated with somebody else. But Delta is really the biggest one. So I think United would probably compare to Delta about the rest. JetBlue and Southwest. Yeah, US Air and US Air combined with American, right? I think they're the same airlines now. I shouldn't even say that. But anyway, JetBlue and Southwest are actually more of a discount market, more of a bargain. They have a different model than like United and Delta. So they're using the operating cost cents per available seat mile. Our benchmarks are 12.78. For United Airlines is 13.65. Delta 14.98. Okay, so these are the numbers to watch, and maybe they pay their pilots more or something like that. I don't know, but you'd have to look at more of the detail in the statement. Operating revenue per seat mile, United Airlines 13.66. Okay, but you can see that Southwest and US Air and Delta all sell better than United, put it that way. Okay, they're getting higher revenue per seat mile. Then operating income, these are cents per available seat mile. 1 cent for American Airlines. See, Alaska Air, this isn't really a good comparable company, 2.06. American, Delta is 0.47, 0.001. To me, it looks like United probably has some pretty big inefficiencies going. Southwest, 1.71. Isn't that something? US Air, 1.67. To me, Southwest is a really efficient airline. And this is from 2014. Yeah, this is a long time ago. Fuel cost, $4.30. These are all in about the same range. You can see Southwest, though, buys fuel futures, so theirs is lower. Delta's is pretty high. It's even higher, $5.50. Labor cost, $4.27. Okay, the average is $3.80, so they're paying more for labor. So isn't this interesting? And these are total available seat miles. This is really the best way to look at this. Delta has 212 available seat miles. I'm surprised United I think they're bigger than United Airlines now, but United is 214. But you can see how small Alaska Air is. JetBlue is also a very small airline. I used to fly them all the time. I didn't realize how small they were. But you can really see that Delta is the only really comparable airline here. Even Southwest, 131. Be interesting to see what these are now. Okay, so let's do some problems.